All right, everyone. We're going to take a look at the various tabs here in the Chapter 11 homework file beyond the other problems that we just worked on in the last video. And so here, we're going to talk about the discussion questions, quick study, etc. So let's dive in with the discussion questions to begin. And as per usual, I'm going to give myself a little extra room. I have to think about word problems. I like to give myself space and not clutter up my screen too much. So that's good for now. Okay, let's start the first one. What time value of money, which time value of money table is always used when considering loans, and why is this true? Put in my text box here. When we're talking about loans and using the time value of money tables, we'll always use the present value of an annuity table. I say when considering loans. This includes the amount of the loan, which is equal to the PVA, or the present value of the annuity, PVA, present value of annuity. The amount of the loan payment is equal to the annuity, and the amount of the interest rate can be solved or given as I in our formulas. And then the amount, again, we kind of noted that the amount borrowed is the present value of the annuity. So if you kind of, think about, the present value being what you are borrowing today, and then all those future payments going forward. When you think about it from an investing perspective, and your money growing, that's good. But when you think about the loan payments, really, this is the bank is the one doing the investing, and you are their investment, basically, right? If someone's lending you money. And so what they're looking at on the lending side is if they put this investment out to you, you are the investment, right? If you're borrowing money, then their money is growing at that rate that you are paying them back interest, essentially. So you kind of just like flip it a little bit, I guess. At least that's the way I sort of think about it, is if you put yourself in the shoes of the lender, then it kind of makes more sense, from a perspective of investment growth and all that kind of stuff, because it's really the kind of the same thing, just seen from a different perspective. So okay, question B, what is capital budgeting? I'm just going to copy and paste in my text box here, and we'll just say capital budgeting is the process of analyzing alternative long-term investments and deciding which assets to acquire or sell. Right, so we looked at chapter 10 was more short-term decisions, but that's why we're doing so much on the time value of money in these problems, is really kind of looking whether, in putting investments, essentially, or capital acquisitions, because those are really more of a long-term kind of a thing, right? So making long-term plans. Okay, let's look at question C. Again, I'm just going to copy and paste in my text boxes here. Okay, identify 4 reasons that capital budgeting decisions by managers are risky. One reason is that the outcome is uncertain, right? We can assume certain things and all that kind of stuff, but especially when we're talking about such a long time frame, there's no way that you can actually predict the future that well. Generally, large amounts of money are involved, so these are usually purchases of expensive buildings or equipment, or different things of that nature. So it's not, small like some of the more small short-term decisions we were talking about before. As I kind of alluded to, investments are long-term and require a long-term commitment, right? This is not a decision that we can easily get out of, and that's kind of, these are all kind of related, but that would be the last one. The decision could be difficult or impossible to reverse. So that's why you need to put a lot of thought into these decisions, right? And like I mentioned, I have a lot of experience in the financial realm, or from working in banking, essentially. In my present, one of my previous careers as a CFO of a lending institution, a bank, kind of a specialized agriculture bank. When we were lending money to borrowers, that every time you lend, I mean, usually large amounts are being involved. There's a lot of times, maybe smaller loans could be made sometimes, but those are big long-term investments, and the outcome is uncertain. The borrower, or the investment in a different scenario could go bankrupt, or whatever the situation could happen, that they can't pay you back, or the investment could go bad in some way. So there's a lot of effort that goes into risk management when you're talking about these kind of decisions, and doing everything you can in your power to assess all the risk factors and come up with good risk management processes, essentially. Okay, D asks, copy here and paste down, give ourselves a little more breathing room. Okay, D says, why is the present value of $100 that you expect to receive 1 year from today worth less than $100 today? What's the present value of $100 that you expect to receive 1 year from today, discounted at 12%? Okay, let's start with the first question then. $100 received today is worth more than $100 received in 1 year because of the time value of money. You could invest the $100 today and have more than $100 at the end of the year, or next year, or whatever they're saying, 1 year from today, basically. Okay, and here, if we are going to, oh my thing keeps going weird. Okay, there we go. The present value of $100 to be received in 1 year. So if we're going to discount that amount, right, and we're at 12, we have a percentage, so we have one to be received in 1 year, discounted at 12, 12% is, and here we can go basically, to our tables, do a little math off to the side. So if we have $100 and we're going to receive that, in 1 year, if we bring that back to current, then we're going to go to our present value tables, right? This is just one payment. It's not the annuity style. So 12% 1 year is going to be 0.893 as a factor. And so if we take the $100 times that it's pretty easy math. It just gives you the 89. We'll round it to two decimals. So let's say $89.29, for example. Right. Or if we say it a different way, if we had $89.29 today and we could earn that amount, if we could earn 12%, right, then we can go to our future value table and say 12% at 1 year is 1.12. And so if we wanted to do it that way, so 12%, 1.12, if we multiply 1.12 times that, that'll bring us exactly to the $100 again, right? So we're just kind of like almost think of it like time traveling, going between the future to the present. And those are the different factors we need to get those amounts to show up. So, perfect. Okay. All righty, let's look at question E. And I guess just one thing to highlight too, I mean, we've kind of used this terminology. The term discounted, right? We might be used to hearing the term discount in regard to a sale, like a sales item or something. You've discounted it by 5% or something. And in the time value of money concept kind of realm that we're talking about today, I think it's hopefully that's clear what we're using that terminology to mean. But just to clarify, that's us basically when we say we're discounting that, it's bringing it back to present value. So it does reduce the amount, like the $100 in 1 year is actually worth $89.29 today if you could earn 12%. So we're discounting it. It's a lower dollar amount, but it's not discounting it like, blue light special that, I was going to say Kmart. I don't even know if Kmart is still around anymore, but at Walmart or something like that, right? So it's not that kind of sale, or not that kind of discount. And it's not the kind of discount we talked about in accounting too, when we're talking about payment terms for inventory and things like that. It's really just the idea of bringing a future value back to a present value due to the time value of money concepts that we've been talking about here. Okay, question E here says, if the present value of the expected net cash flows from a machine discounted at 10% exceeds the amount to be invested, what can you say about the investment's expected rate of return? And what can you say about the expected rate of return if the present value of the net cash flows discounted at 10% is less than the investment amount? Okay, so basically what we can say is if the present value, I'll just put PD, is greater than the cost of the investment, then the rate of return is greater than 10%. And that's where we kind of say, oh yeah, you should make that investment, right? And then alternatively, if it's less than the cost of the investment, then the rate of return is less than 10%, basically. Okay, so I'm getting close. F asks us, why should managers set the required rate of return higher than the rate at which money can be borrowed when making a typical capital budgeting decision? So managers should set the required rate of return higher than the cost of financing so that there will be income left when the financing is paid. So that's that whole idea of some of these problems we're looking at where we're saying the cost of capital is 10%, like in this example above. Because if the cost to borrow money to buy this item is higher than the rate of return, then we're essentially going to be losing money over the long term because of the excess expense that we're going to have to pay due to basically we're comparing the rate of return on your capital investment versus the interest expense associated with borrowing the money to pay for that capital investment. And so if your financing costs exceed your investment returns, then that's not good, right? That's where you're losing money essentially at that point, because your cost of just purchasing the machine and the financing costs are they're more than you're actually producing in earnings. And yeah, that's not good. You don't want to borrow money just to lose money, right? That's kind of like a bad business decision, long term, especially. And there's other factors that take into consideration. Maybe there's some reason that the new equipment, and things of that nature need to be purchased or something. But from a time value money perspective in this chapter, that's really kind of the perspective that we're looking at these problems. Okay, let's go on to our next tab here. Quick study. What's this telling us? Remember, when doing net present value and internal rate of return, use my in-class assignment as a guide and utilize the present value annuity table that I'll provide you if your annual cash flows are equal in amount. The method will be different than Chapter 11 describes. Okay, but it will save you time. Cool. Okay, let's get some space here and take a look at our first question here. It says, this company is planning to invest in a project at a cost of $137,000. This project has the following expected cash flows over its 3-year life. Management requires a 10% rate of return on its investments. So now we're going to compute the net present value of this investment. And to get the present value total on this, use the present value of $1 table 3 times. Okay, so net present value of this investment. And here, let's okay, so let's fill this thing out. So we got year 1, 2, and 3. And we've got 3 different amounts of cash flows. So we can't really do the present value of an annuity table in this one because the cash flows are different throughout the life. I think that's the reason for that. So year 1, 2, 3. Here's our cash inflows. Let's see here. Oh, that's funny. Okay, and then we need to see our discount. Let's call it discount factor. Let's make this look a little better. And our discount factor then is going to be the present value of these amounts. And so when we're bringing this back, we're using 10%. And so let's see, 10% for 1 year, present value, 0.909. Oh, 90999. Let's just do that formatting there. And then the present value of $52,000 in 2 years at 10%. Again, present value table. Now we're at 10% for 2 years is 0.826 or 0.83 will be our factor. And then the third one, 10% at 3 years is 0.751. If we want to see more, that just carries through, but that's that. And then the present value of those amounts, I'll just say PV, present value, is going to be smaller, right? That's what we expect. The dollar today is worth more than the dollar in the future. Okay, so let's multiply these through. Let's drag this down. Okay, and then we can say, let's add these up. Let's add here. And we'll say this is the present value of cash flows. Oh, why is it wrapping the text there? Sorry. Seems funky. Why? I think it won't let me unwrap the text there, which is odd. I don't understand that, but that's funky. Okay, whatever. Let's just do that. Present value of cash flows is this amount. And then our capital investment, so again, this is kind of what we were just talking about previously, was comparing the present value of the future cash flows at the cost of financing to, let's call this capital investment, because we want to make sure that we're making, our investment has a positive return essentially, and that the financing costs don't exceed the earnings. And it said it was 137,000 to, borrow essentially, or if you want to say that. And so the capital investment then will have a net, and then we subtract the capital investment amount from the present value of those future cash flows, and it's positive. So that's cool. And we'll say net present value. And so what we're basically saying, and let me just, because I'm picky about my formatting, let me just do this real quick. We're basically saying that, I'm going to make this negative. And then we'll just add these. Yeah, we'll do it like that. That's okay. So basically what we're saying through this analysis is that there's a positive cash flow, positive return after taking into account the cost of financing for the 10%. And here we say it, we require a 10% rate of return. And so we are over the requirement, in terms of what we're expecting to get there based on using that 10% as a discount factor. And so it's got a positive return, and we have a positive net present value. So that's great. And we should invest. That's kind of the outcome in this chapter from doing those kind of problems. Okay, let me just clean this up a little bit. Okay, so let's go on to problem number 2. Okay, problem number 2 says if Kimball Company invests $100,000 today and it can expect to receive $20,000 at the end of each year for the next 7 years, plus an extra $12,000 at the end of the 7th year, what is the net present value of this investment, and assuming a required 8% return on investments? Okay, so what we want to figure out then is, again, the present value of an annuity here for the $20,000, payments essentially. And then for this little piece of the $12,000, that's a one-time payment. So we're going to get the present value of that single amount just using the present value table there. So let's fill out some. How do we want to put this in? And we've got 8% return. Is what we're requiring, assuming a required 8% return. And let's start with the annuity piece. So the annuity is the $20,000, not $200,000, $20,000. And so if we want to see what the present value of that annuity is, we need to, let's do the table factor basically. So if we are saying 7 years at 8%, let's go to our present value of annuities. 8% for 7 years is 5.2. Oh no, I didn't link. Sorry. Equals. I got a link there. Shoot, what did I say? 7 years, 7 years, 8%. Okay, so that's our table factor then. And so our present value of the annuity, we'll multiply these. We'll say PVA equals annuity times table factor. So the present value of that annuity then is $104,127. That's our present value of annuity essentially. And then so that's that piece. And then the single payment that we're going to receive of $12,000. Say, so future value is $12,000. Our table factor for this one then is going to be present value 8%, 7 years, 8%, 7 years. I'm going to kind of format paint here. And then the present value of the single amount, again, multiply these together, is $7,002 is what I get there. And so then our total present value of future cash flows is just the sum of these two present values. So that comes up to $111,129. That's what I get. And then we need to back out, just like we did up here. It says the present value of the cash flows there. And I'm just going to do that to make this a little closer. So that looks funny. I don't know. Let me change that. I am so picky on my stuff. I'm sorry. Let's do this. So this will be, here, let's use this same terminology here too. Oh, that looks funny. Why is it doing that? Okay, so present value of future cash flows then, and yeah, that's really the total, right? We're adding those two pieces together. Less, I'm just going to write it out here like that. Less the capital investment of $100,000, it tells us in the problem, gives us a net present value of $11,129. So sweet, it comes out positive. So that means we've got it's a viable investment to enter into, essentially, right? Or you know, when we say invest to in this regard, you know, it's kind of like buying a new piece of machinery possibly or something as well. All right. Let's go on to our third problem here. And in our problem number 3, it says Camino Company is considering an investment expected to generate average net income after taxes of $3,825 for 3 years. The investment cost $90,000 with an estimated $12,000 salvage value. Compute the accounting rate of return for this investment, assuming we use straight line depreciation. And then it says, hint, use the following formula when computing the average annual investment. So just beginning value, book value plus ending divided by 2. So nothing really too crazy there. Okay, so let's see here. We've got our annual estimated net income after tax. Oh, shoot. It keeps on making it hard to. There we go. That looks good. Of $3,825. So it tells us here that's what our net income is. And then our average invested amount, again, that's kind of just relatively easy. I'll just type it out, I guess. So beginning, and I'll say ending, and then average divide by 2. So beginning investment amount is the $90,000. And then the ending investment amount, it'll end up at $12,000 basically at the end of the life of this equipment or whatever it is. And then basically we just take our beginning plus the ending divided by 2. So the average investment comes out to $51,000. And so now we can take our accounting rate of return, and to figure the accounting rate of return out, let me get a little more space. We take our average or annual, our net income divided by our average invested amount, and that was the 51,000. And that equals to, get a little more space here. Let's do it down here, accounting rate of return. That looks a little funny, but we'll do this. So we'll do 3,825 divided by 51,000. So basically 7.5% accounting rate of return. All right. So yeah, a few little things on this one, in terms of thinking of this as an investment right at the beginning. And if we have a salvage value, it means that that item's never going to go below that value essentially, right? And so that becomes our ending. And yeah, the accounting rate of return is a little more basic than doing the internal rate of return amount, where we have to figure out the annuity payments, etc., and table factor, so on and so forth. So, okay, I think that's the last one, right? Yep, quick study is done. Let's go on to our exercises. Clean this up just a little bit. Okay, so we got some notes on this one. C1, C2, C3. These are 3 different cheese making projects. C1, each project requires an initial investment of $438,000 and would yield the following annual cash flows. Okay. And what we are trying to figure out is, should any of these projects be acquired, essentially. And then we're going to, let's see, we're going to explain whether the internal rate of return is higher or lower than 12% for project C2. And then we're going to compute the internal rate of return for project C2 as well. Okay, so I think we can, let me go, let's take some of what we did up here, because I think this actually will be a good tool for us when we're analyzing these potential projects. Okay, we have 3 years as well, so that's actually pretty helpful. So our cash flows here are going to just be these amounts. Again, this is for C1. I'm not sure why it's come in looking funny there, formatting wise, but pull these over here. Okay, there we go. And so, okay, so for C1, what the heck is that? Weird. Sorry, I'm trying to figure out why this looks so funny. Okay, that kind of fixed the problem. I don't know. Yeah, it was just floating a little weird there on the table. Okay, so we again have got to look here. It's a 12% return. And so when we're figuring out our discount factor, we're going to look at 12%, for the first year, and we're going to go present value. So 12% first year, 0.893, 12% the second year, 0.797, and then 12% 3 years out is 0.712. And yeah, then we just multiply those together the same way. So we end up with 432,780.61. And there's a little rounding that can happen on these. So I'm linking them straight in. So that should be the right amount there. But that's the present value of our cash flows. And it told us that the amount was 438,374. That's a very specific amount. 438,374. And so we have a negative net present value for project 1. So we'd say, probably shouldn't do that one. We're going to lose money on that project is basically what we're saying. Okay, C2. Let's follow a similar pattern here. So let's bring all our cash flows in. Okay, they're the same over those years, and our formulas, or sorry, our discount factors are going to be the same because we're using the same time frame and the same rate, 12%, and that's going to be the same as well. And so we get, I'm going to do just a little formatting here to show that it's positive. Whoops, I put that in the wrong spot. Okay, so we're summing up all three of those. So the present value of the cash flows for the second one is 46,151, and yeah, and the investment amount is the same. So we have a positive net present value for C2. So that's cool. We would choose, to potentially enter into that project. And let's look at C3 now. Okay, future cash flows. I feel like this got weird again. Yes, this spreadsheet is messing with me. Oh, maybe it's because I had the underline in there or something. Whatever. Okay, I'm just leaving it. Okay. Same factors. Those should all match. Different cash flows. And here you can see, same investment amount it said each time. So we've got a positive net present value on project C3 as well. Okay, and then it asks, so that was part A. Part B says, using the answer from part 1, or part A, I guess, explain whether the internal rate of return is higher or lower than 12% for project C2. And so we can say, since project C2 has a positive NPV, or net present value, we can conclude that the rate of return on the project is higher than 12%. Okay, so that's really kind of what we're analyzing. Okay, and I'm just gonna clean this up a little bit so it's a little tighter. Okay, so there's our 3 cash flow, projections and discounting and all that, net present value calculations. And on 1C, it says compute the internal rate of return for project C2. And what I kind of want to make sure this is shown as A. This is part B. And then we'll do part C down here. Okay, so now we're going to do our internal rate of return calculation. And so kind of, hearkening back to what we did previously when we were, if you watch the video here, on these amounts essentially, let's look at our problem here, and we'll say, what is our, we kind of go through and we use our table, we use our calculated table factor, and then try to see where that falls on the 3-year time frame essentially, right? So our investment then being the I'll put it in here. So investment is 438,374. Jeez. Why is that not good? That's weird. There we go. And then the annual return is going to be let's see, where? Oh, sorry, C2. So is it, one reason we can use the table now too is because C2 has such a consistent return that we're calculating. So it's going to be 192,000. Okay, so we're going to divide our investment by our annual return to get a table factor of 2.28. And so now we can go to our present value of an annuity table and look on the, since it's a 3-year project, we can try and find the 2.28 on the 3-year period. So you can see you got to kind of go over 2.28. So yeah, is it exactly there? 2.28 is 15. Where'd it go? 15%. Now we're on exercises. Oh, 2.2832. That's almost exactly what's on there. So maybe they designed it to be really close to it. So basically what we can say is by using the table factor, calculating it, and then going and reviewing all the columns here, you can see that the table factor that associates with that column would be the 15%. And we can then say that we'll just say internal rate of return then is the 15% with the 2.28 at 3 years there. All right. Is there anything else on that section? No, I think that was everything from the exercises. And yeah, I just was kind of like comparing that back, remember, to how we did. Where is it? Oh, here you go. It's this one. So if we look, and we took our investment divided by our return, take it for the number of years, and then you go over to your table. That's how we did these ones as well. It's actually a little bit easier to see in these problems because you kind of lay out the factors a little bit cleaner and see how you do that division to get the table factor. And it might not be the table factor exactly lines up with, there's infinite space between 14 and 15, 14.1, 14.2, blah, blah, blah. So, but you could get an approximate rate of return by knowing that table factor and then being able to like see how close it is to one or the other. You'd probably be able to say, oh, it's about 13% or it's about 14%, so on and so forth. Okay, so I'm going to just do that little guy because that's the answer that we want, the answer that we need. That's okay. That's everything on this tab. Let's go to the PR. Okay, so let's clean up our spreadsheet here. Okay, so again, use the PVA table if it's equal cash flows, so that's cool. And what we're doing here is looking at two different alternatives. We have a freezer that's in need of repair, and we're considering whether to replace the old freezer with the new freezer or have the old freezer extensively repaired. Information about the two alternatives follows. Management requires a 10% rate of return on its investments. So alternative one is to keep the old freezer and have it repaired. And if it's repaired, it will be kept for another 8 years and then sold for its salvage value. Or we sell the old freezer and buy a new one, and the new freezer is larger than the old one. Oh, excuse me. But will allow the company to expand its product offerings, thereby generating more revenue. Also, it's more efficient and will yield substantial operating cost savings. Okay, so we can kind of see the variables here essentially. And we need to do some calculations here. So determine the net present value of alternative 1 and 2, and which alternative do you recommend that management select? So from that perspective, we've got I didn't even check my check figure here. Oh, look, yeah, 15% or approximately 15%. I mean, it's pretty close when I looked at it there. Is there any other? Yeah, I think that's the only check figure we've seen. Now this one has one here as well. Okay, so let's look at the different factors here. And so what we want to calculate is the cash flows, right, from these alternatives. And so in our first, because kind of what we've been seeing so far is just really telling us like, oh, it's this alternative is going to produce us a certain return, right? So but we need to kind of figure that out in this problem. So let's go ahead and organize this just a little bit. Okay, so alternative number one, that's up here, bit of this information. So our annual revenue, related to this alternative. I'm going to merge these cells just to get this to look a little better. 64,000 in revenues generated. Okay. And then our annual operating costs, annual cash operating costs, that's going to be 54,500 after repair. I guess is that what it's saying? After repair, it's a little cut off there. Okay. And so our net cash flows then, net annual cash flows become just the difference between these two things. So revenues minus costs gives 9,500. Cash inflows, it's positive, so that's cool. And in this factor here, if we're looking to put this into the number of periods, or N, as we've been using that variable in class, N will be 8. It's got 8 years. 8 years life. That's what it's going to last for. And then our I will equal 10%. In this example, it tells us that's what management seeks to require as a rate of return on investments, such as investing into repairing the freezer. Okay, let's see here. So now we're going to use our present value of an annuity table. Let's get a table factor. So we are going to use the 10% and 8. So 10%, right? And then 8 gets us 5. I have to link that. Try that again. 10%, 8 years gives us 5.335 if we shorten it down to 3 decimals. And then we can multiply these together to basically give us the present value of 8 years of annual cash flows. So that would be 50,681.8 basically. Okay, so that's the present value of the cash flow part. And that's kind of similar to what we did up here, right? This just said cash flows, and that one too, especially for any of these, we've been using just the present value factor because they're different amounts. Trying to think of a good example. Here, this is a good one. If it says we've got net cash flows coming in of 20,000, we did this whole analysis. We're kind of doing the same analysis. We're just including the extra component of revenue and expense to get us to what that inflow would be, whereas it just told us before. Okay, and then for the salvage value factor, or like component of this decision, we have $3,000, or link to it. I think it's above. Yeah, salvage value. So we can sell it in the future and get a little bit of money back. And now we just need a table factor. And I'm going to put the PVA here. And then I'm going to say table factor, but just the PV, because this is only one. This was payments over 8 years. This is just the one payment at the end of the 8 years. So we go to our present value table, 10%, 8 years. And we got 0.46 and a bunch of decimals. And so our net present value of salvage value, I guess that's a good way to say it, present value of future salvage value. Excuse me. Oh, felt that one coming. Multiply these together. So the value that we get off that would be about $1,400. You saw with some decimals there. I guess we'll just throw the decimals on. We did it above here. Okay, so then, like I said before, very similar to what we did in this problem, we're going to get total. I'll steal this from that problem and just bring it down here actually. And we'll say total present value of the cash flows. Add those together. Whoops, that's not what I wanted to do. Make this a little more tight. Okay, but add those together, and then the cost of the repair is going to be like our, where is it? 53,000. Let's take off the text wrapping, and so we end up getting a negative net present value out of that alternative. So that's not good. That means we probably shouldn't go in that route. We're going to lose money, essentially, is what we're saying through this analysis. Okay, and I think that's everything, that we need to analyze for that one. That was one. Okay, that's alternative alternative one. So then let's just copy this down. I'll delete out the one, but let's say this is alternative. Oh no, this is two. Sorry. Delete that for two. Okay, alternative two. Let's use a similar breakdown here. So our annual revenue in this instance under alternative two is 68,000. So we're earning extra revenues there. What do we got next? Our operating costs are down quite a bit, 40,000. So that means our net cash flows every year has gone up from 9,500 now to 28,000. So we're earning more cash inflows, and same factors here essentially. So we're going to carry over the same PV, the present value of an annuity factor, and that gives us 149,380. Okay, and then salvage value in number two is 8,000, so it's got a higher salvage value, if we kept it for the same amount of time. And the table factor here is going to be, oops, let me make sure that's coming up to the same. So 5.335, and then this one again is the same table factor we use for the one payment in the future, 8 years in the future, 0.476. So that means that gives us a present value of 3,732.06 off the 8,000. And then let's add those together, and that gives us a total present value of those future cash flows of 153,110, more or less. And then the cost of the new refrigerator, which is our capital investment in this example, is $150,000. sorry, we want to do the net cost here, because we do have, let's see what we have, a salvage value of the old freezer. Okay, so we can, sorry, throw all kinds of wrinkles in here. So if we sell the old freezer, where are we at here? Okay, so it would be 150,000, but we can get a little money from selling the old freezer now. So really, the net cost of buying the new freezer is only 145,000. So we save, it's a little bit less even, because we could sell that freezer today, the old one, and that would produce a positive net present value of about $8,110. And so for 3, it just says, what alternative do you recommend? And so based solely, I shouldn't say solely, this is actually a pretty realistic and nuanced problem. So based on our analysis of all the relevant factors, I'll say based on our analysis, we should select alternative number 2 and buy the new fridge. It yields a better net present value. Yeah, and really what's driving all that, right, is the increase in revenues, the increase in net annual cash flows, essentially, right? Plus, that's kind of the driver there, because we're using the same table factors, and so what you really see is it just bumps it up to a bigger present value calculation, and then we also get a little bit of money back from selling the old freezer. We can sell this new freezer in 8 years, just like we could sell the old one in 8 years, but we're going to get a little more money for it, and that's worth more now today than the old freezer would be. And so when you take all those factors into account, even though it's a more expensive investment up front, right? There's the 53,000 repair costs versus 145,000 purchase. The total present value of those future cash flows is higher, so that what we're saying essentially is that the return on this, capital investment is more beneficial from a financial perspective. Okay, kind of a tricky problem. This has a lot going on in it, and sorry, my video probably glitched there. My recording software just stopped for a moment. It hit its max time limit. So anyway, we're at the end of this problem, but that's this is a pretty involved problem. So what I was saying is, we can check our net present value too, make sure we got it right. Alternative 1, negative 916. We're pretty close. I think they're rounding or something, or I don't know there's some kind of rounding happening, because that is not exact to what our net present value is, but close enough. What was I saying? Yes, you won't see a problem like this specifically on the exam. That's what I was saying. It's kind of a complicated problem. So thanks for walking through that one. Hopefully it sort of gave you more perspective on how to complete those kind of problems. And then we've got this beyond the numbers problem here. And it says, pretend that you are explaining net present value calculations to your best friend who happens to be a rice farmer. What would you tell him about the calculation, or how the calculation works, and why he or she might need to run the calculation? Remember, this needs to be in normal language, not accounting speak. So I'll kind of leave this up to you all. And really what you want to have here, give maybe it's a paragraph long, a few sentences that include points about future cash flows and the initial investment, and basically making the point that net present value is one of the best ways to evaluate a large capital investment. So in essence, let me think about I'd have to think about how to kind of word this in a simple way, but what we're trying to get at is the point that is the revenue generated by that purchase or that capital investment, does it exceed the cost of that investment? So that's probably the way to say it. Does the cost of the investment does the return on the investment exceed the cost of that investment, such as purchasing a piece of equipment? And you might even say, in perspective of talking to like someone who's a farmer or something, for example, you might say it in terms of, if you buy a new piece of equipment, is it actually going to pay for itself? You know what I mean? That's probably a good way to say it. Is the revenue that you're going to earn on that new piece of equipment worth the cost of purchasing it, especially including the cost of financing associated with it if you're taking out a loan? So something to that effect, that really is what we're trying to get at. Yeah, it does. Does the piece of machinery pay for itself? Does it actually generate enough earnings to cover the cost of what it takes to purchase that equipment or to repair that freezer, for example, in the last problem we looked at. So, all right, well, I'll let you all kind of take what I was getting at there, hopefully, and write a little paragraph out. Hopefully you are still with me here. This is a little bit of a complicated chapter in terms of some of the theory and putting this into place for rate of return and present, lots of tables and all the fun stuff. We will do some practice problems in class, and we'll kind of hone in on how to use these skills to be able to solve the kind of problems that you'll have on the exam. So we'll do some test prep basically with these as well to get you all feeling comfortable, because this is a pretty expansive topic and can really get relatively complicated, and I don't want you to feel overwhelmed when it comes to the kind of problems we're going to do on the exam. So hopefully that makes you feel maybe a little better if your head's spinning at the end of this walkthrough session. So thanks everybody. Hopefully you found this valuable, and I will see you all in another video, or I'll see you all in class. I think this is actually, no, we have one more chapter to cover after this. We go into chapter 13 as well. So we will see another series of videos. So I will see you all in those or in class. Hope you all are doing great, and we'll talk